Valens Research, Uniform Financial Analytics.
Nestle, for those of you who don't know, obviously one of the largest chocolate and confectionery makers in the world. And for Nestle, and this is the joy of talking about international companies. I should have had these companies open up beforehand because all of these are international, as I just have to pull up what the company is, and that's SWX, NESN. And so for Nestle, what's really powerful, if you notice from the invite, is Nestle has much stronger profitability than as reported metrics reflect in reality. What Nestle really does in terms of their returns is they actually have returns that are almost 4x what the market has. And as we jump into the company, you'll see the power of this signal. Just one moment, please. So for Nestle here, when we come into the company, what we're seeing here is what we see every single time, the first time that we analyze a company. So we always start with our uniform accounting research with the Valens Research app at what we call the PVP chart. What does PVP stand for? Performance, valuation, prime. Again, we're very literal people here. We're looking at the performance of the company in terms of its return on assets and its asset growth. We're looking at the company's valuations relative to its asset base, and valuations relative to its earnings base to understand what's the company's real performance and how is the market paying for that. And just starting with return on assets first for the business, what's really powerful for Nestle, right, is when you look at this is the as reported distorted return on assets for Nestle, right? If you just take the IFRS numbers for Nestle and you plug them in, what is the performance? You see a 7% return on assets business, a pretty flat and stagnant business over the last really 20 years, 15 years, and not that particularly profitable, right? I mean, a 7% return on assets isn't much above your cost of capital. But what we see when we turn on the uniform accounting data is two things. One, we see return on assets is actually 3 times higher than as reported metrics mentioned, which makes a lot more sense if you step back and think about it. Nestle is a massive chocolate company, right? It has phenomenally powerful brands. It has pricing power in the market. You would expect it to be a high return business. This is the power of uniform accounting, right? If you think about it, as reported metrics often just don't make sense when you're analyzing a company. But when you see the right numbers, you can see the reality, which is it's actually more profitable. And not just that, returns have been rising recently. They haven't been stagnant. Even more so, we can start to understand performance of a company when we look at the asset growth for a company also. What we can see here for asset growth for the company is uniform accounting versus as reported assets. This company, part of the reason how it's actually got that return on asset expansion is actually it's been shrinking more than as reported metrics reflect, which helps us matrix, because really if we think about these two metrics in tandem, we can think about return on assets and asset growth as actually a more thoughtful way when you're looking at the right data to think about free cash flow, right? A company that has high returns is a company that's throwing off a lot of operating cash flow, and a company that's investing or disinvesting is actually releasing cash flow or actually investing more. And part of the reason why this is so powerful is, as opposed to oftentimes when you look at a free cash flow metric, and you could see a company like, we always talk about the example of Home Depot back in the, the early 2000s, the 1990s, that might have negative free cash flow, but has negative free cash flow, not because it's a bad business, but because it has high returns and is reinvesting in the business. You can also understand the same thing when you see a company like Nestle and you see free cash flow ramping for the business, but it's really because the company is releasing cash from the asset base. Well, that's something we need to be aware of. And if we look, really, the as reported metrics miss the order of magnitude here. But right, just looking at performance alone doesn't tell us whether or not we should buy or sell a stock. That just tells us how good a company has been. The next question we have to ask is, what's the market paying for the company and what's it pricing in? And that's when we get to these two charts, valued asset prime ratio, which is our version of a cleaned up price to book asset metric, and valued earnings prime ratio, which is our version of a cleaned up PE. And what you can see here, which is really interesting, is on a PE basis, we see even more data that's relevant here. This company isn't a company that's trading at a 25 times multiple, only slightly above what as reported metric, what the average PE is in the market. In reality, this company is trading at a 32 times PE. And so when we look at that, what we can all of a sudden see is this company isn't as cheap as we think it is. And that actually comes out especially when we look lastly down here at TSR. So what TSR is, for those of you who don't know, TSR stands for total shareholder return. What does that mean? That means what is the total gain you would have seen in this company between capital appreciation, like the stock rising, and also any dividend income you would have gotten in the company. And the R here, the little r, is relative. Relative to what? In this case, it's relative to the relevant Swiss index because this is a Swiss company, and we're comparing its performance versus its whole entire market. When this is flat, that means the company performed in line with peers. When it's rising, that means the company outperformed the market, its market. And when it's falling, like here, that means the company underperformed the market. And what's really powerful here is we often see a very strong relationship between this here uniform return on assets and a company's TSR that we don't see with the as reported metrics. We can kind of see it here. You can see as the company sustained profitability over this period, the company continued to outperform. As returns rolled over, TSR actually rolled over. And as returns now have been in a kind of secular growth trend, TSR has also continued to outperform in a way you wouldn't see looking at the as reported metrics, because the market doesn't pay attention to the garbage in, garbage out issues with as reported metrics. Even that though, right, understanding what historic profitability and valuations are still doesn't get us to a buy and sell decision. And that's when we get to this chart right here, which really is what unlocks some of the most powerful things that we can do with uniform accounting, which isn't just understanding performance, it's understanding what the market's pricing in for a company to do to see if it makes sense when we can compare it against reality. And so what we can see here is these two light bars are what Wall Street sell-side analysts are forecasting return on assets for Nestle to be for the next 2 years, basically for ROA to be flat with 2019, 2020, and for asset growth. The market, in essence, analysts are forecasting for asset growth to be positive after being mostly shrinking the last couple of years. These white bars are at a 330 billion Swiss franc and a 119 Swiss franc dollar stock price, what the market is pricing Nestle to do. So all of a sudden, looking at this chart, because we know we're starting with the right data for historic performance, we can figure out whether or not we think it makes sense that Nestle is valued how it is. Do we think Nestle, that was a 15% return on asset business and now it's a 20, is going to get up to a 28% ROA? Do we think that Nestle, which is a company that for 3 of the last 6 years has actually shrunk more than 5%, is going to steadily grow at 3% a year, call it basically global GDP growth? Well, let's look. Probably that feels like a high expectation for us. Now, we might say, very reasonably, and we don't have an opinion on Nestle, by the way. We're just using this as an illustration, as an example. But we might say, Nestle, you know what? Long-term, actually growing at GDP growth, we'll give you that. They've right-sized their business. They've rationalized it. Let's assume they're going to grow at that. But now, let's actually ask what we think is going to happen for return on assets. If we think return on assets is actually going to be 20%, and we can play with this using our really simple embedded expectation tool here, right? We can plug in what we think return on assets and asset growth are going to be. Then we say, let's see what the stock price is going to be if we do that. If Nestle has ROA that's just flat going forward and asset growth that's basically global GDP growth, this company might be 30% less than it is right here. And here's the thing. I don't know if this is actually the right scenario or not for Nestle, but what I do know is you could not possibly come to that kind of conclusion, that kind of discussion to understand what your outlook is for a company if you didn't have the right data to start the conversation in the first place. And that's what's so powerful about the uniform accounting data is it helps you get to the conversation you need to have. What is the market thinking for the company and how does that compare to performance faster than you could if you're spending all your time building models that might not even be the right data if it's driven by arcane accounting mathematics.
Valens Research, the world's leading source for uniform financial analytics.